All right, hopefully this works. Is this on? Am I getting louder? That sounds a bit better. Thank you very much, everyone, for joining. I know that it's vaguely cruel to put a benchmarking session at 4 p.m. at the end of the conference. It's about as hardcore as it gets, but it is going to be a good session. It's going to be way more exciting than it might sound, mainly because of these guys. But in all seriousness, this is a really important session. Thank you all for coming. It's really important because we're going to be talking about whether benchmarks and indices can drive real economy decarbonisation, about whether the market is innovating its way towards something meaningful here, or whether this is just sort of product development and a bit of denial about bigger problems in the financial markets. The reason that this is so important, and I'm sure I don't need to tell most of you here, but is because of the size and importance of passive investment as an asset class. Harvard Business School estimates about 40% of the US stock market was held by passive investors in 2021. You know, we're talking about 16 trillion in ETFs and index mutual funds, according to Morningstar. So this is really big size, and lots of it committed to net zero one way or another. Now, I did earlier this year ask the Net Zero Asset Managers Alliance, the Net Zero Asset Owners Alliance, and those guys if they could tell me how much of the assets committed through them to net zero were run passively, and they don't have that information. So a little bit tricky to get visibility on exactly the size of the challenge here. But we do know it's huge. And we do have 4 wonderful panelists who are going to give us a bit more visibility on the reality of meeting that challenge, regardless of how big it is. So it's my absolute pleasure to introduce Craig McKenzie, Head of Sustainability, Multi-Asset and Investment Solutions at Aberdeen and a lecturer at the University of Edinburgh. Dr. Ellen Quigley, Responsible Investment Advisor to the Chief Financial Officer at the University of Cambridge. Jacob Thoma, Project Director at the Inevitable Policy Response, Research Director at the Finance Labs. They've all got such long job titles on this panel. And Lee Clements, Head of Applied Sustainable Investment Research at FTSE Russell. Thank you all very much for joining us. Jacob, I'm going to start with you, if I can. You were once, and people will associate you, many people will still associate you with 2 Degrees Investing Initiative, and I know that 2 Degrees was a big voice on benchmarks before many people were paying attention. Do you want to kick us off by telling us what the problem is here, sort of big picture?
Sure, thanks, and thanks for the opportunity to speak. So, Sophie, as you've already obviously highlighted, benchmarks are the northern star of financial markets. You mentioned the passive investing, but we all know that active investors contain a large number of closet indexers, so that number is in reality even higher. And they are a big barrier, in our view, to climate-aligned investing because, on the one hand, they suggest that they reflect the market when they don't. I'll say a minute more about why I think that. And the second is that they actually typically lag the climate ambition because they're large cap, market cap weighted benchmarks, which means if you have mid to small cap companies that are on general more likely to be green, more new companies that bring solutions, typically an investor that is in a traditional market cap weighted benchmark is going to be the last one to eat at the green solutions table. And so obviously kind of switching from these mainstream benchmarks to climate benchmarks would be one way to think about that shift, but it would also clearly represent, at the end of the day, a revolution in finance, right? So this idea that we would really systematically move away from cap-weighted mainstream benchmarks is one that feels the closest thing to, using Anne Simpson's word from last night, impossible. The solutions that I'm sure we'll get more into that are obviously these beta index solutions, but they don't really respond to one of the core issues, which is what I mentioned off the top, is that market cap weighted benchmarks don't represent the market because they don't actually represent broad diversification. We're now seeing a situation where market cap weighted benchmarks are so overweight in tech companies, for example, that they are breaking diversification rules in the US and in Europe. And so these benchmarks are not really truly diversified. And one of the ways that we think about it is that beta indexes that have a carbon tilt or what have you is one way we think about it, but really we should also challenge whether these indexes really represent the climate-aligned market. And so we need to revisit that rationale. I hope we get to do that in the course of the conversation, but obviously also challenge the suite of beta index solutions around climate that we have in the market, notably around this blending that we see around reducing emissions now and having a decarbonisation pathway, which led a large suite of MSCI low carbon indexes to actually lag the mainstream benchmark in year-to-year emissions reduction for many years, but obviously also the real-world emissions reduction question around stewardship and the fact that the reweighting engineers the emissions reduction in the benchmark typically and not the underlying corporate emissions reduction.
Okay, so that's the issue around paper decarbonisation
Exactly.
versus real economy decarbonisation.
Right.
Sure. Okay, Lee, well, you're supposed to be fixing all of this at FTSE. Tell us, I mean, the response from the market so far, as Jacob sort of points out, is not to really address some of the problems with mainstream indices, but it is to come up with innovations around dedicated products. Can you talk us through what that's looked like?
Yes, it's, you know, I wouldn't say I would agree with the fact that it doesn't represent the market, but it does represent a lot of assets and a growing amount of assets, because it is a popular way for a whole range of investors to invest. And there has been a lot of focus and interest on coming up with better solutions, be they focused on areas of the market, such as green technologies, be they focused on trying to address companies that are either decarbonising faster or have policies in place to try to decarbonise faster. And there's about $1 trillion of assets index-based. I mean, it's across a range of different types of things. Some in ETF, about a third in ETFs, a lot in large asset owner mandates that have some form of SI overlay on them. The majority of that, though, is not focused on net zero. The vast majority of that is focused on divestment or some form of ESG best-in-class type approach. There's a lot of focus now to try to move the climate part of the market from what has traditionally been a cross-sectional reduction in carbon. So the majority of the market is quite obsessed with the FTSE All World is X amount of carbon intensity. A new index which was 50% lower, let's say, carbon intensity. And that was the majority of the climate market if you look about 3-4 years ago. That got shaken up quite a lot by the regulations, particularly from the EU with the Paris-aligned benchmarks. And that has brought a chunk of capital in. The majority of the Paris-aligned benchmark funds that we see are actually funds that existed before the rules and have had their regulations changed. And there's a lot of focus now on moving from cross-sectional carbon to year-on-year carbon to the focus on forward-looking, so trying to look at where a company's going rather than where it is at the moment.
Okay, so I'm going to ask you in a second to just explain the EU regulation a little bit, because I think it's worth visiting. People tend to talk about it at very top level, but it's useful to... so if you were an investor 3 or 4 years ago, you're looking at a sector-neutral index where the ambition was to do better on carbon than the benchmark, and then the EU stepped in and said, no, you've got to do better than you did last year.
Yes.
That's the decarbonisation ambition that we've seen more recently. And can you just briefly elaborate a little bit on what PABs and CTBs are for anyone who isn't reading it like we are?
There were EU rules for naming benchmarks. They weren't really benchmarks as such, they were thresholds there. So there were various rules around PABs had to have a 50% reduction in carbon emissions, had to have a somewhat complex 7% year-on-year reduction in overall portfolio emissions adjusted for inflation in underlying enterprise value to investment capital. I would say that's not something that we design, that's something that's imposed upon us, and there's a bunch of other rules there around divestment, so different degrees of divestment around coal, power generating assets, gas and so on, depending on the percentage of the business, a divestment rule around coal. I'm trying to remember if I've covered everything. And you need to maintain the same ratio of high impact sector and low impact sector within there, so that you don't just change the weighting of the portfolio, so go from energy into healthcare to go within there. What I would say though is that a lot of those rules have been, there were a bunch of voluntary rules that were put in place around exposure to green technologies, around forward-looking. There's a bunch of rules around bringing Scope 3 emissions into those targets now as well. So it is a very complex area, which, if anything, is something that has somewhat put investors off there from transparency reasons.
Okay, so the transparency reasons were the motivation. So the EU stepped in, so there's not enough transparency around this, there's not enough credibility around this sort of space. Here are 2 labels that we've developed. Here's the methodologies that you should use if you want to adopt a Paris-aligned benchmark label or a climate transition benchmark label. And they're very, very complicated. And there has been a bit of a pushback from the investor community over the last sort of year around them. There was a big influx of adoption from investors, I think it's fair to say, and then a bit of a cooling off. And I think the Net Zero Asset, I want to say owners, but it might be Managers Alliance, put out some stuff last year saying we might need to revisit our aspirations around benchmarks. And there's a new kind of wave of...
There's a new wave, so there were, as I say, about half, from what we see, about half of the current PAB, CTB index funds are ones that existed before the rules. And about half of the number that I've got looking on my spreadsheets is about $60 billion, around half of which flowed in since the adoption of the rules. But that has been slowing down. The area that's growing is actually PAB debt funds, which are about 20% of the current market there, but have received about 50% of the flows in the last year. So we see that as a growing area, which I think is good because it's more direct capital there. But there have been pushbacks on it, partly because of complexity. One of the main drivers of the pushbacks that we see is actually in terms of turnover. So in order to get to some of those targets, particularly the one on the 7% year-on-year decarbonisation, whilst investing in a universe of companies, it's creating a lot of turnover because corporate decarbonisation is not even, and it's definitely not all on a 7% threshold. So in order to achieve it, which is what we're required to do in order to have that regulatory piece, you would either have to have a very, very, very small number of companies in your index, or you need to change the weighting of those companies. And that turnover is what is really scaring investors that we speak to, because that equates to additional cost, and cost is a big element of the index world.
Okay.
Can I just add, this is obviously exactly the point about the real versus virtual emissions reduction. All of a sudden, we're incentivizing turnover in these indexes, and what signals are we sending to corporates when you're getting kicked in and out of these indexes every year, depending on this irregular decarbonization that Lee highlighted?
Yeah, absolutely, and I think it's a matter of engineering the way out of this situation and increasing costs for investors. So there's some pushback, there's some rethinking going on. We'll talk a little bit later about what some of the innovations are that are coming in the next generation of thinking. But Craig, from your perspective, we have a problem with mainstream indices. It's been tried to be solved by these innovations, we're hitting another stumbling block. Does any of this make sense? Is the theory of change right here? Is the cost of capital going to change? What?
Yeah, so I think that's the kind of key question. What's the theory of change here? How are indices, the existence of indices, cleverly designed indices maybe, going to drive real decarbonisation in the world? And I think there are kind of two arguments that are made. One is a cost of capital argument, and the other is a kind of reputation signalling type argument. The cost of capital argument is, basically, by being in the index, you're going to have a higher share price than you would have done otherwise. You can then raise capital more cheaply than you would have done otherwise, and you can put that capital to work building gigafactories and other good things. And there are kind of possible examples of this. Tesla itself is, I think, an example where, particularly 4 or 5 years ago, massive enthusiasm for Tesla, which was not necessarily mostly from ESG people, it was mostly probably from Elon fanboys and day traders, but whoever was behind it blew the share price of Tesla to $1 trillion, and Elon Musk issued lots of new capital at the very high share price very, very cheaply, and was therefore able to build out his charging networks and his gigafactories, which let him steal a march on his competitors and helped move EVs forward. So there is a cost of capital story there that kind of works. Whether Tesla is a pretty unique case, it's very hard to come up with other examples, is an interesting one. But in this context, the really interesting question is an index likely to drive the share price of its constituents up substantially? And the evidence there is pretty thin. Even there's some event studies that have been done on companies that join the S&P 500 after not having been in the S&P 500. And in the first few weeks after joining, their share price does go up over a peer group that didn't join, but that fades away. And there's very little evidence of long-term effects from participation even in these mainstream indices. And we can maybe talk about this later, but there are plenty of kind of theoretical arguments about why cost of capital really oughtn't to shift very much, because fundamentals haven't changed. And ultimately, while you can have bubbles and bubbles shift cost of capital, fundamentally, the net present value of the entity hasn't changed, and so its share price can't change in the long run. So I'm dubious about cost of capital as a mechanism here, and yet that's probably the one that is most talked about as a way for net zero indices to achieve things. And actually, it's not just the indices, it's the active stuff as well. But anyway, putting that to one side. The other idea is a signalling reputational argument, that you have a really authoritative index where if you're in it, people really believe you're delivering net zero as a company. If you're not in it, that's a bit dodgy and you're not really deserving our respect. And if you're a CEO that kind of wants to stand up amongst the peer group and get your knighthood if you're in England, you need to be in the index. And there is some evidence that in the early days, FTSE for Good motivated some British companies to change their policies. So you can see that could work. But in the context of net zero indices, there are so many different methodologies, there are different standards, there's probably going to be regulatory competition between the PAB and the EU ones, and maybe we'll come up with some new standards in the UK to compete, and Asia might come up with its own standards. And of course, different index companies have their own commercial reasons for wanting to have different kinds of indices. So you're not going to, I'd be quite surprised if over the next decade we see a really authoritative net zero index that's really well designed, that everybody who is committed to net zero wants to be in, and there's a kind of signalling reputation effect. But it's not impossible. I think, and I'll stop now, but I think the real question, if you want to claim cost of capital as your mechanism, is you need to be able to come up with a credible story about how your index or your index design is really going to concentrate capital into probably a relatively small number of companies, or deny capital to another relatively small number of companies. If you can't do that, you really can't start to make claims about cost of capital. There we go.
Fab. Okay, problems, challenges, challenges. Ellen, can we solve them? Is this a matter of innovating our way towards something better, or is this a problem with indices more broadly? What's your kind of experience of working with these from a Cambridge perspective?
Thanks, Sophie. So I'll just lay my cards out on the table here. I'm generally skeptical of stock picking in public equity, and even with indices with fancy tilts or exclusions, I'm just generally skeptical that that will have an impact. I do think that at least, I mean, the studies that you're talking about with the FTSE for Good, Craig, I think part of the problem is something that Lee and Jakob were talking about, which is that this turnover mechanism actually means that that signal goes away as well. And that's kind of the one thing you would expect to make some difference on the public equity indices side of things. But I personally don't, I think it's a good way if you're a fund manager of getting extra fees from your clients, but otherwise I'm not convinced that that would have much of an impact on companies. I think on the debt side is where you're more likely to see an effect, as Craig was saying, and I'm actually just going to come back to your last challenge there, Craig, in a moment. There are three main reasons that on the debt side you're more likely to see some changes. There is what you were talking about before, Craig, about additionality. There are quite a few studies now that find at least some effect on cost of capital on the debt side, because again, that's primary market capital, not secondary market capital swirling around as it is on the public equity side. The other thing is that it actually includes issuers that aren't listed. So it's getting at a wider array of companies that might not normally get the attention of responsible investors. So that's pretty key. The other thing is just that, I mean, I was pleased to hear what you said, Lee, about, you know, the much more inflow into debt products, but to date, we've mainly seen focus on public equity products, and that means that there's a profusion of them. And so companies are hearing a whole bunch of different things from a whole bunch of different offerings, and that it makes it less likely that they're going to be able to concentrate on any particular ask, and therefore have a clear signal as to how they can change their behavior. And that seems like a pretty significant problem if you were hoping for behavior change. So just to return to Craig's point about cost of capital, how you need to have kind of a pretty specific strategy there. I mean, I would suggest that you look at who needs to raise capital and for what particularly high impact ends. My bugbear is the lack of attention that's paid to the construction of new fossil fuel infrastructure that locks in long-term emissions. So I'm talking about coal plants, gas plants, pipelines, etc. Missing from all sorts of methodologies, to my great frustration. And that is the sort of thing you need to go to, you normally would raise funds in the debt markets for. And that's a very good basis on which to exclude a company. If they're planning on building a new coal or gas-fired power plant, then they would probably be more sensitive to any impact on cost of capital, because the internal hurdle rate is already pretty comparable. I mean, with coal, it's already more expensive than new renewables. Gas depends on the market, but it's pretty close. So if you can nudge the cost of capital on that, you've actually got a credible theory of change for how you're actually going to stop some of this new fossil fuel infrastructure from getting built in the first place, really shifting the numbers for company decision-making over something that could end up being in place for well over 60 years. We have a lot of infrastructure now that has been running for decades and decades and decades. So anyway, my team is actually building a nonprofit bond index that is focused on, it is a corporate debt, and it's looking at one of the top indicators is, are you building new fossil fuel infrastructure? Because again, this seems like a big gap. It seems like something that would have an effect from shifts in cost of capital, and it's very observable, not so ungameable. You can tell from space whether someone's building a new power plant.
Okay, interesting. All right, so in some ways I'm getting the sense that there's a feeling that indices are best used when it comes to real economy decarbonisation through more concentrated portfolios, through more specific strategies. Certain asset classes can achieve it, certain asset classes are not built to. It doesn't really solve the problem for big investors who've just committed their passive strategies through these initiatives to actually doing this. Now, does that mean that it's okay for those public equities or big corporate bond mainstream portfolios to not achieve real economy, just stick with the paper stuff, just go with the innovations that are there, and do the real economy decarbonisation through those more concentrated or innovative strategies? Or do we have to find a workaround for this? Jacob, do you have any thoughts on that?
Well, I think you make a good point, Sophie, right? Like we've started with problems because the panel is impact. But obviously in some original sense, the objectives of these indices is to create an investable solution for the targets that you've set, which you're trying to have impact with, but you actually have a more narrow kind of ask. And there's obviously a little bit of a chicken and egg problem here, because index providers I talk to about this say, well, we provide our cap-weighted benchmarks and these solutions because that's what our clients want. And then the clients say, well, we feel like we're not being really well served by many of the index providers because of all these complexities and these issues that we've just talked about. So I think, just to unpack this, like the first thing is we need passive solutions that are consistent with the climate targets set in terms of the exposure of portfolios of financial institutions. Will this have impact, cost on capital, et cetera, et cetera? That's a second question. But for this first question, already here, I think we do need to have just a better generation of more intelligent solutions. It feels like we're being underserved because so much of this is these sort of somewhat esoteric at times, complex products, and the index providers, in my view, are unwilling to open the box that has cap-weighted benchmarks written on it, right? That is just a box because that's the moneymaker, that's what everyone wants. And so saying, well, if we're thinking about even active funds who are looking for a parent benchmark as an investable universe, right? Craig, you talked about these different aspects, but like that matters, is to be in the investable universe. And if GFANs with the large of asset owners in them says, look, we're going to change the way we think about an investable universe, that I think is a new type of way that could be a thoughtful story. I think the second thing is there is a growing thought about trying to develop solutions that move away from this index optimization the way I think we've traditionally thought about it, which is sort of you have a parent benchmark, then you move exposures up and down, and you sort of create some kind of engine around it, and saying, look, well, maybe we just have an index where we just allow companies to be in there that have a science-based target, for example, right? And this is just the rule. And if it's 10, then it's 10. And if there's 500 of them, then there's 500 of them. And I'm not here about to just people who know me know I have my own relationship with Science-Based Targets Initiative. But, I think that is where, as somebody who's advocated for complexity for many years, maybe that is where simplicity actually can be helpful, because the signal is clear. Everyone knows what I need to do to get into this index. The turnover situation is also much clearer. Sure, you may be adding companies as you're increasing universe. There's ways to constrain that, obviously, but also you're not permanently kicking out companies because now you got to find some median balance. And there is, I think, a rubber hits the road moment for the way beta index were conceptualized, which is tilt away from parent benchmarks, and which means this kind of cross-corporate performance optimization on ESG or climate issues, to something that maybe requires a bit of blank paper, like what I think you're describing potentially is, sort of a second generation of filters around, well, we'll only include companies, like Lee said, maybe only companies that have the 7%. Leaving many of them there's very few of them indeed.
Well, that would create a lot of turnover, because 1 year they'll be in, 1 year they won't.
Yeah, but that's the problem with the underlying metric of the 7%. So I agree with you, but if you had something like a science-based target or a lowered something where companies have a more consistent performance level against, like no coal is probably a pretty consistent performance level for most companies. Not a lot of companies build coal 1 year, stop building it the next, build it again the next, right? So I think this is where, but that's where often as we point to the index providers, but to be honest, we need to point to the asset owners who need to be more courageous and more bold, and going to the investment committees and going to the boards and saying, we think we should not have the MSCI World as our parent benchmark. If we're a GFAN signatory, it is just at some fundamental level absolutely incompatible. And it's a violation of your GFAN's commitment if you continue to do that, in my view.
I disagree with that a little bit. I agree with most of what you said. Is it okay? I just, it doesn't bother me if people have an MSCI, if they track MSCI on the public equity side, as long as they're voting against the re-election of directors of companies that are, you know, building new fossil fuel infrastructure or whatever. And I think if you're looking at the only way that we're actually going to get real economy decarbonisation, which by the way helps everybody meet their fancy portfolio decarbonisation targets, is to actually decrease emissions in the real world. So then you have to look at what makes it more likely that that will happen, and probably combining tactics such that for the same company, let's say you own a utility, and that utility is planning on building new gas power plants. By the way, that's happening all over Europe still, so this is not like a hypothetical. It's probably more likely to change their behavior if you increase the cost of capital by keeping them out of a bond index on the debt side, or excluding them otherwise in an active bond portfolio, and then vote against the directors on the public equity side. So you're using the strongest tool that you've got in different asset classes, making it very difficult for that company to do anything other than accede to your desires, especially obviously if you work with others in pushing for that.
Just very briefly, I think I hear you, right? There's some question around your tilting versus engagement strategy, but at the end of the day, the MSCI world is the functional equivalent of a planning economy in financial markets in terms of how it sets the agenda for basically the majority of investors. And I think it's really hard to just simply look at public markets and say, if you don't change your reference point, and then just saying engagement, it doesn't mean you have to immediately kick out a bunch of companies, but changing the reference point is part of the pledge that you've made, actually. And so that inconsistency, I think, is not simply resolved by saying we'll stick to the old guns and then do engagement.
Lee, can I just ask Lee to come in, because I think there's been a lot said about index providers.
I would agree with some elements. I would disagree with the fact that cap-weighted benchmarks are the problem, because simple solutions that you were talking about are alternatives to those cap-weighted benchmarks, some of which are tilted, some of which are simpler, are definitely out there. And the high turnover situation that I was talking about earlier is a very small part of the SI index market. That has been particularly kicked off by some of these complex regulated benchmarks, but that's 5–6% of the $1 trillion. The vast majority is mainly in the divestment. I mean, there's a huge thing of how do you define what is or isn't a fund or an index. But if you look at the whole way of somebody who's trying to do SI or naming it with an SI name, the vast majority aren't these highly engineered, high turnover type indices. If anything, the index industry is trying to resist being pushed into that space, and it's the regulators who have been pushing us into that space. It doesn't help us at all. It's you know, believe me, there's a lot of people in our operational department who would prefer to have different solutions than some of those ones. And if anything, the things that we're seeing more interest in are the ones that are trying to look for more stable ways of defining a company, such as their involvement in green solutions, EU taxonomy, whatever definition you want, or companies that are engaged in target setting and real activity on that basis, which for us is the work that we do in collaboration with the TPI and the London School of Economics. So that's tending to be where you were talking about the new generation of net zero.
Sort of briefly explain the thinking, because it has moved on to a different way of looking forward from what the EU may have suggested, maybe in this new way.
There's still a dichotomy between a lot of the market and a lot of where investors are more comfortable are in the simpler solutions. However, there is also a desire to try to, whether you're trying to create impact, which is a very kind of loaded phrase, or you're just wanting to not have your capital sitting within the companies that are doing certain things from a more kind of ethical side of the market. There is a desire to move that equity capital towards companies, and particularly when we're talking about climate and net zero, companies where they are doing the things to transition rather than just it's different when you look at high carbon and low carbon. There's desire to have more in the companies that are doing the transition, and particularly within the higher carbon companies within that space. So what we're seeing is a lot more data trying to say how engaged a company is with the transition. That's what our TPI index uses, and then trying to overlay that. I mean, in our case, trying to say, if you've got a certain amount of carbon today and you're more engaged, we think that there will be less carbon tomorrow. And if you kind of, it's far more complicated than just multiplying it together, but looking at that to try and say, where do we think the future decarbonisation is, which is part of a big push to, and I'm kind of using inverted commas here, to be more forward-looking within the data.
So it's forward-looking, but not forward-looking the way the EU wants people to be forward-looking, which is you have to decarbonise on a certain trajectory. You're saying the new thinking is let's be simpler. The forward-looking metrics are basically how a company is managed and the signals they're sending off around transition.
There was a voluntary element of the EU PAB around forward-looking data, right, but it wasn't always used.
But they've got a forward-looking trajectory.
They've
That's
got a trajectory.
The deviation
they've
from
got
the
a
previous
backward-looking trajectory, effectively. It's on existing decarbonisation. And that's what's creating a lot of the turnover. To be honest, if we were on a 7% trajectory globally, then you wouldn't have the turnover problem.
Right, so this is the big question, right? The EU regulation is built for a world in which this stuff is happening. It isn't happening, so people are looking for other things. Craig, thoughts on all of this?
Yeah, so I mean, Thomas, Jacob's sort of SBTI idea, and let's put that in sort of scare quotes because it could be something slightly different, isn't actually all that different from your kind of TPI trajectory and management scoring idea. You're basically saying companies need to be committed credibly to a transition in order to be in the index. And that as a first step in the theory of change, I think that works because those are the kind of companies you want to reward. That's the behavior you want to reward. But then you need a lot of investors to be behind it so that companies want it. And so I suppose you would want kind of the net zero asset owner group to say, in future, whenever we use indices, we're going to have this rule that those indices need to meet some standards, either SBTI or a TPI type standard, but they need to meet some standards. And if enough asset owners got behind it, and allegedly GFANZ speaks for tens of trillions of assets under management, that would give an incentive, at least for companies that can relatively easily adopt SBTI targets, so not super carbon intensive companies. I imagine that would be a workable theory of change. The question is whether you're really going to get asset owners at scale to adopt what may turn out, at least initially, to be quite a restrictive index, because the tracking error of that versus the market cap indices will probably be quite large, and then you're going to get people on the investment committee waving their fiduciary duty hands and saying, well, what if it underperforms over the next 2 or 3 years? Which it might, because we're not on a net zero trajectory as a world.
I think there are I think there are some other issues with that, and you know, Net Zero Asset Owner Alliance did come out with a set of best practice principles, I think they described them, for these indices, and they talked about, they didn't name specific things like SBTI or TPI, but they described them fairly closely as to what they would want there. I think one of the issues that you will face with applying that at the moment will be, if you go into the data, what you will end up with in that index will be something that is, and I know you're saying it's not the representative of the broader market, but certainly compared with the market indices used today, far more focused on developed markets, far more focused on large companies. Because where you look at the data, whether it's the targets, whether the TPI type numbers, or whether you look at most ESG scores, they tend to be highest with developed market companies, larger companies, for all kinds of issues around disclosure and so on there. And personally, I would argue that doesn't necessarily could harm a lot of companies a lot more there. They're all good ideas, and I think over time they will develop there, and that's where a lot of people are looking. But we've done a number of pieces of work with very large asset owners around some of the impacts of this, and so the end solution tends to be using a number of other pieces of data to kind of adjust the weightings to take into account the biases.
One thing that FTSE Russell did with FTSE for Good in the early days, because there was a similar problem with FTSE for Good, that it was mainly European companies that had really good sustainability reporting, human rights policies, etc., and EM companies were just nowhere. FTSE Russell announced a kind of 5-year plan to gradually ramp up the criteria for EM. So DM had to meet higher standards, and EM then gradually ramped up the criteria. And they managed to get and there was a lot of communication, a lot of engagement with the companies, and they managed to get quite a lot of companies in. Okay. And I imagine that kind of, as long as you were phasing it and focusing mostly initially on large cap developed world companies, and then spread the love slowly.
And engagement is clearly a big part of all of these if you're going to be effective. You took a deep breath like you wanted to say
yes,
something.
I couldn't help it. Just to come in on that, I mean, I think the devil really is in the details here, and some of what you've both been raising now points to one of the fundamental issues that we have with the various methodologies that we're using, including FTSE for Good and others. It's a real emphasis on reporting and other things that you know, if you have a little department that can do that in a European company, you're going to be able to do that. Does that really correlate to actual emissions impact? I question that. I mean,
no, it's SBTI. So the FTSE for Good example was just a change model. Sure. SBTI would be the thing, and it would have to be credible SBTI.
Sure, because the problem is SBTI, again, apologies for anyone in the room who's affiliated, but there are loopholes there that you can drive a truck through. Same with TPI. I'm sorry, it's just true. So it is going to be easier for these things to be gamed by companies that have a lot of resources to attend to this and have pressures to do so. So those are going to be, you know, disproportionately European companies. But for all my critiques of Climate Action 100+, it's highlighted to us that it's a relatively small number of large companies that are externalizing most of the costs associated with climate change. It isn't, we're not talking about thousands of companies we have to worry about so much as, you know, the 166 or whatever. I would add banks and insurers, but whatever. So I think it actually points to a broader problem that we've got with all the methodologies that we're feeding into indices. But I also question why we picked some of these targets in the first place. So, you know, why have all of these investors committed to portfolio decarbonization targets when that's unlikely to result in the real world decarbonization that would actually deliver on those targets in the first place? I'm at a loss.
So I'm going to come back just to, if people want to ask questions, just put your hand up and I'll start to feed them in. Because I'm keen. We've got a mic somewhere. Can we get and then I'm going to come back to the panel and just, because there were, did anyone want to respond to Ellen's?
Shocking suggestion that net zero activity by investors is not going to lead to real world decarbonisation. I mean, I'm blown away.
We're really coming off the top rope today here in the panel.
It's the last session of the summit we're allowed.
Not the last session, there's a debate.
There's a debate, but obviously that's in a different league, Jacob. Please, go for it.
Thanks. That's working. Simon Hallett, Net Zero Investment Consultants Initiative. So I guess two things. Firstly, we've been kind of dancing around a topic here about portfolio decarbonisation. Can we agree that sort of backward-looking sort of EU Paris-aligned benchmarks that build in a mechanical 7% decarbonisation are just a really terrible idea?
Yes.
Because it's like we're dancing around that one. And I suppose the thing that, you know, Craig kind of skewered some of the theories of change around capital allocation, I thought, fairly effectively. Engagement is the sort of the USP of big index managers. So they should be impactful in that. So it seemed a great shame to take their capital away from high carbon intensity businesses that we need to change, and we also need to finance the change. So how do we kind of, square that? Because I'm super attracted to the idea of a simple index that is just for aligned companies, but that seems like ticking an objective box, not change. And if a net zero strategy should be about driving change, it kind of has to engage with high intensity companies. Where does that? How do we ensure that change is happening where it needs to happen, rather than just us sitting on the sidelines and hoping somebody else does it?
Yeah, and I guess part of this is, does the change need to happen before the index can accommodate it? Does the engagement need to be with real economy policy and things like that as part of the strategy? Or can you actually achieve the change at kind of constituent level? Do you have any thoughts?
Yeah, I mean, I think, and it's worth highlighting here, right, that GFANZ has the index investing workstream that they've initiated as part of their key program this year. The first meeting is, I think, in next week or something like that. I'm going to be on there, so if people have thoughts, I'm keen to get them afterwards as well. So, part of this is also surfacing this truth, right? Like this whole issue of, oh, they won't do it. It's kind of, let's not be critical before it's happened. If I would say that, we need to give people a little bit of time to onboard the implementation, and if then, as Lee said, they're unwilling to basically effectively consistently implement net zero because of the fiduciary duty fallout that may come with that, then that may be uncomfortable and may be that's a problem, obviously, but at least we've surfaced this and we can discuss it and debate it and reflect on it. We may see more people depart the initiative, but maybe that's also sort of a bit of a culling that could be actually quite a positive dynamic. I think the sequencing that you highlight is quite an interesting question. I would challenge the idea that we've somehow decided that engagement is way superior to capital allocation because of many of the arguments made, but engagement has its own warts, and we've seen the Church of England reflect that just recently. I mean, at the end of the day, I think the most important part of the process has to be a consistent incentive setting for companies, right? So where you have this turnover gaming, where you have this unclear index rules, where you have this over-engineered thing, or where you have toothless engagement, you're not getting anywhere. So we need to think about what does that look like. And simplicity is one aspect, obviously, to the extent that it's compatible with the underlying complexity of the issue that we're actually debating. We should sometimes we need to accept that this isn't just super simple. But the other thing is like an asset owner that says tomorrow, all right, well, we have two strategies. We have our engagement strategy and we have our aligned strategy. And we allocate capital to companies that are aligned, and we allocate capital perhaps in a more traditional way. And what we're going to be doing is ramping up our aligned portfolio over the next 10 years. And every year, basically, the amount of money available to companies that aren't listening to our engagement strategy is going to shrink. The same way you have your 7% decarbonisation rate at like index level, you can actually have that, if you will, in kind of more macro strategic asset allocation level. And I think that would be a creative way to say, look, on the one hand, we're already rewarding the aligners. You can immediately move into this pot. Nobody's preventing you from doing that literally today or tomorrow. On the other hand, everyone who's like, well, I'm in this engagement group, I still have access to capital from this investor, but I know that pot is shrinking. So if I'm not ready to respond to that engagement, and maybe I'm not, and then I'm out, and maybe I don't need to because I'm an emerging market company that has a different pool of investors than the more developed markets focused GFANZ signatory base, but maybe I do really care about that, and I don't want to be caught out in 10 years when that residual pool all of a sudden is only 10% of the portfolio allocation or 5%. But that requires a kind of courage that, at least when it comes to passive products, I just don't think we've seen because of the basis points constraints that we have in the passive products, because of the unwillingness to move away from the parent index and the market cap weighted benchmarks as the mainstream view, and obviously because of the regulators basically throwing wrenches into, I think, what was a much more productive process beforehand.
Interesting. Okay, Craig, and while Craig answers, can we get the mic to Khalid, and then there's a gentleman 2 rows behind Khalid.
Just on this idea of let's focus on the companies that really matter, the carbon-intensive companies. I think there's another theory of change problem with that, which is that I think a relatively soft incentive of the kind we've been talking about, like a well-designed index and asset owners sending strong signals, can persuade relatively low carbon intensity companies to adopt SBTI targets and genuinely move on them, because the cost of doing so is relatively small, and the pain of not being recognized as a leader is more significant maybe. And so that works. But for companies that are very carbon intensive, where the marginal abatement cost of decarbonisation is very high, and there isn't a policy framework like the EU ETS or other regulations to drive the change fast, they're not going to be able to afford to do it. So there is this little incentive here that we're providing, saying, yeah, you guys do it, and they're going to say, well, yeah, we'll pretend to do it, we'll sign up to SBTI, we'll do what the Church of England told us to do. Oh, the oil price has gone up, we better invest a bit more in new reserves. Because the economics is just so against them. And I think that's the problem. It works in Europe because there is a regulatory regime that is vaguely net zero aligned. It doesn't work in EM, doesn't work in the US particularly well. There are some bits it does. So I think, but that doesn't mean we throw away the idea. I think it would be really great if the 50–60% of companies in the world who have relatively low cost of abatement could be convinced to adopt SBTI targets and really follow through. That would be a real achievement of investors. That would be a huge thing. But instead, we spend so much time focusing on these companies that won't change because of us. We should stop it. And I'm glad to see some investors are now stopping it, and they're going to focus elsewhere. But
yeah, just to say, I do think it's really important that we distinguish between stocks and flows here, right? So the asset allocation question is really about, like, if we're talking about a company that is genuine about transitioning and they need capital to do that, they are overwhelmingly going to get that new capital on the debt side. And frankly, I just don't think there are that many companies in the category that you're talking about, Craig, where there's, you know, marginal costs and they're a high impact company. Like, those are...
Well, an EM utility company.
Sure, okay, so utilities, like, thank you, this is exactly where I wanted to go. I mean, I feel like there's an opportunity here to not worry so much about the public equity side, use the director votes, which is I believe, a significantly stronger tool. You can wake up a board really quickly with 10% of investors opposing re-election in uncontested elections. It is a pretty effective tool. And then you are, to your earlier point, Craig, less likely to run into fiduciary duty related issues because your variation in returns isn't likely to be as high. And then you can have those difficult discussions on the debt side and maybe focus on, I would say, focus on utilities. It's still the biggest high-emitting sector, and it is relatively easy to transition. You've got these huge infrastructure projects that are still going up that make the difference between various temperature goals that we might want to have.
But, there is still a need, as well as penalising the bad companies, there's still a need for more capacity for the solutions that will drive net zero, which will come partly from debt, but a lot of that will come from equity as well. Some of it venture capital, but that will eventually find its way onto the public equity market as well.
Sure, in utilities though, it is mainly going to be debt, right?
For the companies putting it in, for the companies producing the capacity to make the solar panels and the wind turbines and so on, or the next generation of technologies, that's where it's not all debt.
Yeah, this is why we need a primary market strategy, right? Like, that's where asset allocation makes the most sense. I'm seeing some nods. Thank you, people.
Everyone loves it, but I don't know how easy it is to achieve. Khalid, thank you for waiting.
Sorry to intrude on that exchange. I could hear that go on for a while. Just taking the cue from Sophie's point about simple solutions. With regards to engagement, is it as simple as sort of broadening or extending the window that indices can use to achieve that average 7% decarbonisation? At the moment, it's just 2 years, maybe 5 to 7 years. Maybe that would be sufficient time for kind of engagement strategies to take effect. And secondly, on solution providers, there's been a push from forums such as the G7 and jurisdictions such as Japan to recognise avoided emissions. And by definition, obviously depending on the assumptions you're taking, that would be real-world decarbonisation. Would PABs or CTBs based on avoided emissions be, you know, an idea worth exploring? Thanks.
Okay, thank you, Khalid. And there's a gentleman 2 rows behind. Have you got a mic? Okay. And can you introduce yourself before you ask your question, please?
Oh, sorry, I thought you were
Thank
going to answer Khaled's question first. One comment before the question is this has been a fantastic exchange across the panel. It's difference of views and being able to freely express those respectfully. It's been great, so thank you for that. The question that I have is, and Sophie, choose to ignore it or not, it's a little bit tangential to the topic of decarbonisation, linked to, but it extends it. This is. Be interested in Craig's and Ellen's thoughts on the viability and if so, would necessary trade-offs of extending this conversation from beyond simple decarbonisation to being able to include into our portfolios tilts towards and against, to be able to affect other elements of the E, such as nature and biodiversity, but also elements of S. So can we create an index on a passive side that allows us to be able to move beyond just decarbonisation, but to also incorporate these other elements of more of a just transition as opposed to simply portfolio decarbonisation?
Thank you. Who wants to go first on any of those questions? Craig?
Avoided emissions, I think, is a very interesting concept. So this is the idea of investing in, I don't know, wind farms, and the wind farms displace coal, and then you avoid emissions. There are huge challenges in calculating avoided emissions and attributing the avoided emissions down the value chain. Was it the wind farm? Was it the turbine manufacturer? Was it the people who made the copper that went into the turbine? And how do you allocate the avoided emission benefit? But there is work on this, and it's kind of interesting. The challenge is, so that's one challenge. Another challenge is you add this into the mix, you make them these indices even more complicated. You do kind of, it does address a problem with a lot of these indices that actually kind of climate solution type companies don't get positively weighted. I know they do in some, but a lot of the indices don't actually give positive weight to the companies that are making the technologies that avoid emissions. So that would be positive, but it makes things more complicated. And then if we add on nature positive, just transition elements too, and frankly, let's also add in human rights and other positive things, we end up with something absolutely immensely complicated. And one of the reasons, and this is a whole other conference topic, one of the reasons why the EU taxonomy is in such a deep mess is because it's tried to add on the kitchen sink, and it's hard to find any companies that are aligned with the taxonomy. So it's in principle, yes, but in practice, we haven't got time.
Yeah.
I would say that that's illustrative of a lot of these issues. In principle, there's a lot of good ideas. In practice, it's very difficult to put them into a practical solution, which is people trying to do that. It's probably the foremost on our minds there, particularly given the amounts of capital that can move when these things go right.
Okay. Any thoughts?
Yeah, I think it's a really interesting question. I'm also very much a fan of keeping things as simple as possible. And one of the things we've learned from our own engagements with fund managers and banks at Cambridge is that they're much more likely to act if you give them one or two things that you'll be watching, and they'll do almost nothing if you give them a big long list. So I would just say this, I'm a little bit obsessed with lock-in, but I think for a good reason. So I would apply that to biodiversity loss as well. So for example, there are dozens of plastics facilities currently being built in the United States and other places. So I would start with things like that are getting built now that will haunt us for decades, but also the flip side, right? There's stuff that we could build now that we would benefit from for decades. So I think thinking about that lock-in piece as a kind of high-level indicator. And then in terms of social stuff, I think, again, it's really complicated. So I would, again, keep it quite simple, and shout out to the Church of England and MBIM here, because they've been looking at the combination of living wage and executive pay. And from a universal ownership perspective, trying to decrease inequality on both ends is more likely to produce a healthy economy. So I would focus very simply on measurements that aren't as gameable, and where you could see a kind of systemic effect like that.
Jacob, I suspect you've got something to say. Can we get a mic to the lady at the back while Jacob answers, please?
Sure. So I think quickly on Khalid's 7% timeline, well, beyond the fact that I think the indexes are nonsense, so I wouldn't recommend fixing the unfixable, but the idea that you want to have a longer time period, I guess it just kind of clashes with the philosophy of passive, right? And so I wonder if we're just trying to, again, bring everything under one hat rather than, even if the principle is clear, makes sense, right? Just clash a little bit. And then quickly on the avoid emissions, I mean, there's a reason GHG protocol has never come out with corporate avoided emission standards, because they think it didn't fly. But obviously the problem of a climate solutions company growing, having typically higher carbon footprint because they tend to be more, materials heavy type of companies, flies in the face of some of the decarbonisation targets. So reflecting that is definitely, and just very briefly on the lock-in. So I don't think lock-in is the right way to think about it, because it's not really locked in, it's what the demand, we can't lock in the demand. If we lock in the supply, quote unquote, but the demand changes, then it just becomes a stranded assets.
But the lock-in on the demand side is the coal and gas plants, right?
Yeah, but if we get, for example, there's a lot of initiatives on the final end user of electricity and them building their own facilities and having renewable energy contracts and this type of thing. So that, sure, it's depending on where you are in the chain, but ultimately, I think there's sometimes of a misrepresentation in CA100 Plus of saying these are the biggest emitters. Yes, but a lot of them are kind of basically trying to solve the drug problem by focusing on the cartels, and we know how that policy went in the 1980s and 1990s, and I think we should learn from that for this exercise here.
Have you got you've got a mic, right? Okay. Once you finish, can you pass it back to the lady behind you, and then the lady in the green? Did you still want to ask a question? Can we take all three at once, and then if we've got time, there's another question there. But thank you. And can we keep them brief? And can you introduce yourself?
I'll try and keep it brief. So I'm Tex Harding. I'm a professional trustee. I am one of the asset owners that you were talking about earlier. And we've essentially got a choice between investing broadly and focusing on engagement, which the evidence says hasn't worked, and logic will tell you won't work for the world's biggest emitters in the absence of a coherent policy response, or investing narrowly and completely missing arguments about universal ownership, but maybe protecting some of your beneficiaries from stranded asset risk. Neither of those appears a great response, and you've just got to pick which you think is least bad. What we really need to do is get that coherent policy response so that you can pick one of those routes that works depending on what the policy is. A lot of asset owners, though, will draw the line at government engagement on these issues, because that is arguably beyond the realms of what your job is as a trustee. So who is doing that policy engagement? How do we get that to actually work? And do you think asset owners should be involved?
Big question, not necessarily passive question, but I think one of the themes that's come through the whole conference is where are the governments and how do we make them happen? Question, please.
Hi, Deborah McCoy. I work for Bain & Company, where I'm a partner. My question follows along this line of asset owners. I was interested in the discussion. I think we kind of barely touched on strategic asset allocation and some tracking error questions. But I suppose there is something interesting. If one just reads the news, you could look over the last 5 to 7 years and see a number of asset owners allocating to and then changing allocations based on their changing preferences. Some combination of preferred exclusions, different definitions for how climate or carbon might be classified. And so while we talked a lot about this, I think I lost audio, it's back. And what the asset managers are doing, is any of you engaging in a coordinated way with asset owners to think of what would it look like for them to align, even outside of policy mandates, around carbon issues, because there is so much heterogeneity right now in what they request?
Okay, there's some nodding going on. Third question, and I think that might have to be our last because we've only got a couple of minutes for answers.
Thanks, I'll be quick. My name's Laura, I'm from the Church of England Pensions Board. Thanks for all of the shout outs about us during the discussion. Just quickly, I'm just interested in the premise of the question. I'd be interested in anyone's reflections on the idea that we seem to be assuming that all investors who've signed up to these initiatives want more than paper decarbonisation. Do they actually want that? What do you think?
So many questions that aren't about passive.
I wouldn't say they're all not about passive.
Go on, you kick us off then.
Well, the question about the governments and the policy, I think is a key one there, whether you look at the scope that listed equities covers of the amount of global emissions or the ability to affect change. And we've done quite a lot of work on government bond benchmarks, because there's an increasing amount of passive investment in government bonds as well as corporate bonds, and there is a real reluctance to engage with governments around that, which when I see, you know, and I've worked at a number of places, including a very large bond trading house, when I see the amount of power that they have when they talk with governments, when, particularly in the current environment, they're buying government debt, and, you know, I can't remember how many days it was that Liz Truss was in power, and ultimately the movements of the bond government, the gilt market, unseated her. There's a lot of potential power that these indices can have, or the investors, sorry, can have within government bond market. So, and we're providing passive solutions for that.
And I would say on asset owners and government bonds, there is something called A-score, which is being developed, which is an attempt to try and engage on climate with government bonds by asset owners. Who wants to go next? Jacob?
There's nothing important enough to say that will keep you from ending on time, so I'll happy to pass to the rest of the...
Ellen, anything that you want to add?
Just to briefly say, I love the asset owner / universal owner related questions. I do think that universal owners are very well aligned with governments for a whole bunch of systemic reasons. And unfortunately, there is a big range in terms of the willingness and ability for universal owners to engage with policymakers. Some feel like they're actually barred from doing so. Others are very willing. But I think wherever they can, they could have a really big impact. And again, governments, legislation, regulation is sadly very needed. And probably the help of universal owners could really help boost government efforts.
So I think policy is, in terms of theory of change, policy is absolutely central to solving these problems, and investors don't do nearly enough policy engagement. Sometimes it's been done well. IGCC's done some good policy engagement, but it's not done nearly enough, doesn't get nearly enough resource. However, if you look at where global emissions growth is going to happen in the next 20 years, it's mostly in Asia. And so really, I mean, Europe is, okay, we could do a little bit better, but we're doing reasonably well. And we're relatively tiny emissions now. We're at 10% of global emissions. The US, well, they've just done their Inflation Reduction Act, which is a pretty good step. But because of the politics there, investor policy engagement is probably not a good idea at the moment. And who knows where that's going to get. And the US is a significant emitter and important for other reasons. So it's quite hard to see you're going to get traction there. In Asia, it's really difficult to see where you're going to go. Where are you going to engage with China? India is promising, and there might be a bit of room there, and Indonesia and some of the smaller Asian countries. But it's a hugely challenging ask, I think, for European investors to set up an Asian engagement office, policy engagement office, become expert in Asian politics and policy, and then drive that forward. That would be an interesting project, actually, but it's not round the corner, I don't think.
There you go. Maybe that's something we can discuss at next year's conference. Right, I need to wrap up. I want to say a huge thank you to our panelists for a really great quality discussion on a very technical topic. So thank you very much indeed. Thank you to everyone who asked really thoughtful, engaging questions. There is now a debate which you must not miss unless you really have to get a train, but please try and be there. It's going to be great. It was fantastic last year. You can grab lots of the panelists and carry on this conversation there. But otherwise, thank you very, very much for attending the conference. Send lots of ideas of what we should be talking about next year. And yeah, big thank you to everyone. Thanks.